students, in this video let's understand how to prepare journal entries and how to post them in the ledgers. Okay, let's take an example of an illustration one here in the website. I'm taking this from the Google. Okay, here they have given a problem: journalize the following transaction and post them in the ledger. Year 2006, January 1st, commenced business with cash 50,000. So here business is being commenced. As we know, they have specified the asset here, that is a cash is a current asset. The journal entry for this is, you can see here, cash account, debtor to capital account, 50,000 to be debited in cash and 50,000 to be credited in capital account. The narration for this is commenced business with cash. Next, the transaction is on January 3rd paid into bank. Means here the cash is paid into bank, cash in the hand is reducing, amount in the bank is increasing. That means the transaction, the bank account is debiting and cash account is crediting. The transaction, the journal entry here for this transaction is on January 3rd, bank account debited with 25,000 to cash account, that is 25,000. Bank account debtors to cash account 25,000 amount. The narration here is cash paid in the bank. Next transaction, January 5th, purchase furniture for cash. Obviously they are directly saying here that the furniture is being purchased by paying the cash. Cash in your hand is reducing because you have paid it to buy the furniture. Furniture is increasing. Furniture is an asset, so here you have to specify that asset. The journal entry on January 5th is furniture account debtor to cash account. Amount is 5,000. Okay, so the narration is purchase furniture for cash. However, you write the narration like we write in the classroom, being furniture purchase for cash. Something you can write it, not necessary that it should be perfect or something like that. It is in your own words, which is understandable, which can be easily understandable when you are reviewing those journal entries. Next, on January 8th, paid for carriage. I said you that carriage is a form of expenses. When we are paying a carriage, you are spending some amount. Okay, that is, you are paying the cash here. Carriage is a form of expenses. Expenses here is increasing. When expenses increases, you have to debit that, and cash is decreasing here, that you should credit. Okay, cash is an asset, asset is decreasing here, expenses is increasing. So here carriage account debtor to cash account, 500 rupees being cash paid for carriage charges, something you can write as a narration. Next is on January 14th, purchase goods from K. Murthy 35,000. On January 14th, goods are purchased from K. Murthy. You can see here goods, business goods are being purchased from K. Murthy, who has not paid us the money. Okay, that's why we have taken his name. He is a creditor for us. Creditor is a liability for the business. Liability in the business is increasing because we have purchased the goods worth rupees 35,000 from Mr. K. Murthy, which we have to pay it later. Okay, so here the amount is 35,000 should be debited to purchase account and 35,000 should be credited to K. Murthy, who is a creditor for our business. This is a short-term liability. We call it as a current liability. Narration being goods purchased on credit. Next, on January 18th, cash sales 32,000. January 20th, sold goods to Ashok on credit. Yeah, we can take this later. First, let's conclude first we'll do till here January 18th cash sales. So here we know that two accounts are being hit. One is on January 18th, one is cash account, another one is sales account. So here cash is coming, sales is a revenue item, revenue is increasing. When revenue is increasing, we credit that item, sales item, we credit it. Cash is increasing in the business, hence we are debiting that item here. So the cash account is 32,000 should be debited and sales account 32,000 should be credited. The narration should be that being goods sold for cash. On January 20th, the remaining part of this here, on January 20th, sold goods to Ashok on credit. Now we have sold the goods to Ashok and on credit basis, Ashok is a debtor to us. Okay, Ashok is a debtor to us. He has not paid us the money yet. Debtors are increasing. Debtor is a current asset. Debtor is a current asset. When an asset increases, we have to debit that. So here Ashok at debtor is increasing. He has to pay us money. It is still pending to be received. Hence, we are debiting that item 28,000 to sales account because we have sold goods to Ashok, that is a revenue item to us worth rupees 28,000. Okay, so the narration here is being goods sold to Ashok on credit. Next, on January 25th, paid cash to K Murthy in full settlement 34,200. Okay, I think in the last transaction, if you observe on January 14th, we had purchased goods from K Murthy on 35,000 amount on credit. Okay, but here we have paid him now in full settlement. How much? 34,200. How much we had to pay is 35,000, but now on 25th of January we have paid him 34,200. Means as we paid him, he has given us a discount of 800 rupees. The difference between this 35,000 and 34,200 is 800 rupees, right? So that 800 rupees is a discount given by K Murthy to us because we paid that money to him quickly without making him it as a bad debts or something. Okay, we are very credit worthy to him and we are paying it on time to him. That's why he has given us a discount of rupees 800. So we have paid him now 34,200 instead of paying 35,000. Whatever it is, let's make an entry here. You can see here we paid to K Murthy. As we paid to K Murthy, now we are debiting that. That means here K Murthy was a creditor to us, it was a liability to us. Now as we paid to him, that liability is reducing, that's why we are debiting here. Okay, liability is reducing, that's why we are debiting here. Cash in our hand is reducing as we are paying to him and we got a discount. Discount is a form of income or revenue. You can say that you are crediting. So here cash is reducing, because of that you are crediting. Discount you are crediting because it is a form of income or revenue to your business. Okay, when it is increasing in your business, okay, revenue or income is increasing in your business, you have to credit that item, right, as per the dealer concept. So here 800 rupees of discount, which is invisible but actually you have taken. That means instead of paying 35,000, you paid 34,200 rupees. 800 rupees is a form of income to your business, okay, which is invisible. Okay, so here cash paid to K Murthy, a discount allowed by him is a narration. Next, on January 28th, cash received from Ashok. Did we sold? Yeah, on January 18th. On January 20th, okay, January 20th we had sold goods to Naresh on credit for 28,000, right? On January 20th he has paid us the money back. That is not full settlement, but he has paid us a 20,000 rupees out of 28,000 rupees. So here we have to show that where is Naresh? Ashok, right? So here you can see on January 28th, cash account, cash is coming to our hand and in because it is coming, it is increasing in her hand. Asset is increasing in her hand, hence we have debited that. He is a debtor to us. Ashok was a debtor to us. Now debtor is a current asset. It is reducing, that's why we have credited here. Okay, debtor is a current asset. If it is increasing, we should debit it. If it is decreasing, we should credit it. Why it is decreasing? Because he has paid the 20,000 amount to us. Remaining 8,000 is there pending, but still he has paid us a 20,000. Okay, so that is the entry for this. Next is on January 31st, paid rent for the month 2000. For the month of that January, the rent has been paid. That amount is 2000. The entry for that is rent account. Rent is a form of expenses. Now rent is paid in the form of cash. Cash is reducing in our hand because we have paid it. The entry is rent account debtor to cash account. That is 2000 amount being cash paid for rent. Next, on January 31st, another transaction has held. Withdrew from bank for private use or personal use, that is drawings only. Okay, so here the owner, they have not specified, but still it withdrew from bank for personal use. It is directly a form of drawings only. So here, as they have specified, the amount is drawn from a bank, we are hitting it into a bank account. So on January 31st, drawings account debtor to bank account, that is 2,500 rupees is debited, because drawings, when we are drawing the money from the business, drawings are increasing. When drawings are increasing, we have to debit that item as per the modern rules of accounting. Bank account, because we are drawing the money from the bank, here the cash in the bank is reducing. So that is, amount is reducing. That amount is reducing means asset is reducing. Okay, so when asset is reducing, decreasing, we have to credit that. That is, bank account is credited. The narration here is being cash withdrawn from bank for domestic use or personal use or private use, whatever it is, that is being cash withdrawn from the bank for private use, domestic use, etc. So that is about the journal entries. When they have given these kind of questions, first we have to record the journal entries, or they may directly say to prepare the ledger accounts. So let's understand how to prepare the ledger accounts. See, a ledger account is prepared in this form. We call the ledger account as a T form account also. You can see why do we call this as T form accounts. Here you can see that this is like this. Okay, this line is that horizontal and vertical line is there, where we distribute this into two form, left side and right side. Left side also you can see date, particulars, journal folio, like we have a ledger folio in when we are writing the journal entries. Here we write the journal folio, the number, page number of that particular journal entry. Okay, next amount. Right side also we will get the same items, that date, particular, journal folio and amount in rupees. Here what we are doing, why we have to prepare these ledgers, we have to identify what is the amount which should be debited, which should be credited, what is left out, which should be carried forwarded, okay, for the next month, something like that. So for the next period, whatever the amount we have to carry forward, what the amount is have to be debited or credited to a trial balance. On picking those trial balance amount, we have to prepare a profit and loss account and the balance sheet or any other bank financial statement. For that, we need to have a proper account maintained. This is not sufficient, because if you see that we have made lot many cash transactions in this, right? From beginning from January 1st to January 31st, we have made lot many cash transactions. We have purchased so much of things. We have done bank transactions. So all these are like it's a data. Now we have to convert this data into an information. We want to know how many cash transactions are done, how much cash I had in my hand, how much I have spent, whom I have given, who has given a cash to me, like that. How, let's assume that furniture account, if I say how much of furniture I have purchased during that particular month, and if I have sold furniture or any depreciation allowed, everything I want to know about that particular asset, or I want to know about my debtor and my creditors. Okay, any expenses I have done or drawings I have done, everything I can get to know easily with the help of the ledger accounts. So that is what we call it here as a ledger accounts. So here, if you observe, what is this ledgers accounts are prepared? If you observe here, the first transaction was based on that commence business with cash rupees 50,000. The journal entry for that was cash account data to capital account. Here you have to prepare two accounts. One is cash account, another one is capital account. See here, how are you preparing that? Here you can see that cash account is a title of this ledger. Okay, where you will prepare this T account, you will put date particular GF amount, again right side date particular GF amount, left side it should be debtor, right side it should be creditor. Also like that you have to prepare a capital account, and you have to put this entry, distribute this entry, that is what we call it as a double entry. Okay, cash account data to capital account, cash account data to capital account, cash account data to capital account. How much was the amount? 50,000. Correct? 50,000. In the same way, if you read it ulta, okay, if you read it ulta, what is that? Cash account data to capital account, capital account credited with cash account, right? So credited by cash account. So here you can say capital account credited by cash account, the same 50,000. So what are you understanding here? There was a first transaction held on January 1st. That was a transaction, a a transaction was that a business was started with the cash. Hence, the transaction was like capital account data to cash account. Journal entry was like capital account data to cash account. So here, that journal entry you have to record it in a two ledgers. One is cash account ledger, other one is capital account ledger. As the entry itself is saying cash account data to capital account, cash account, you will be debited that capital account. The amount is 50,000 on that January 1st. The same entry ulta you have to record in the capital account credited by cash account on January 1st, 50,000. Okay, like that. Next, what happens I will tell you later. So next, bank account data to cash account on January 3rd, amount is 25,000. Two accounts are required here, bank account and cash account. Cash account we have already opened. Now you have to open a bank account. So what you will do, you will open one bank account in the same T format. Okay, so the transaction is saying that what is the journal entry? Bank account data to cash account 25,000. So first you go to bank account data to cash account on January 2nd, 25,000. Now ulta of that, cash account credited by bank account on January 3rd, 25,000. Yes, you are understanding now? Whatever the transactions relating to cash, debit or credit, everything will come and sit in this one particular T account, that is ledger account, cash account. Okay, so next transaction says that on January 5th, furniture account data to cash account. Cash account we already have. We have to open one furniture account. Amount is 5,000. So here furniture account data to cash account 5,000 rupees. First you will go to furniture account. You will open one furniture account on that particular date. I think it's not January 2nd. It should be, what is should be the date? On January 5th actually. Okay, on January 5th a furniture is being purchased. So on it should be here January 5th, furniture account data to cash account 5,000. Okay, next on cash account, how will it will reflect now? Cash account credited by furniture account. Here they have given a correct date, January 5th. Furniture is being purchased, hence it is being credited 5000 rupees. Okay, so that is how we are recording. Next transaction is purchases account. On January 8th, purchases account data to bank account. Amount is 15,000. So here on January 8th, purchases account data to bank account. So we have already opened a bank account. Now we need to open one purchase account. So purchases account data to bank account. Assume now you opened one purchased account. Now you have to debit that bank account. Here amount is 15,000. Ulta of this is in bank account, right? But in bank account you have to go credit that into a purchase account, that is amount 15,000. Okay, on January 8th. Okay, they have given here January 1st drawings account, that you can write it later. First purchases account on January 8th, purchases account 15,000. Okay, ignore this as of now. Next, on January 8th के बाद January 14th, you can see purchases account data to K Murthy account. See, K Murthy is a person to whom we had to give a money, right? We had purchased the goods and we had to give a money. So purchases account we have. Now we have to open a credit, that is K Murthy account. K Murthy account is being opened here, right? In what is the transaction journal entry is purchases account data to K Murthy account 35,000. So here you can see in purchases account data to K Murthy account on January 14 35,000. Ulta of this is K Murthy account credited by purchases account. Where is K Murthy account? K Murthy account is here. K Murthy account credited by purchases account on January 14th. Amount is 35,000. Right? That is written. Next, we go to the next transaction. That is on January 18th. Cash account. Okay, one second. Not on January 18th. I think we left something. We did not take this January 8th carriage account data to cash account. This we have missed, I think. Okay. So carriage account data to cash account. Cash account we have already. We have to open one carriage account. Carriage account में जाके we will debit that amount. Yes. Carriage account data to cash account. In cash account we go and credit that amount. Right, cash account credited by carriage account 500 rupees. That is how we are recording the transaction here. Next, next is on January 18th, cash account data to sales account. So we have a cash account, we need to open a sales account. Okay, cash account data to sales account 32,000 rupees, that is debited. Okay, now in sales account we have to credit that sales account. We opened the sales account in the T format and there we credited the amount sales account credited by cash account 32,000 on January 18th. That is how we do it. Next transaction is Ashok. Yes, on January 20th, Ashok account data to sales account. Sales account we have opened now. We need to open one Ashok's account. Ashok is a data to us. Okay, sales account we have to open Ashok account. Ashok account data to sales account. Assume that you open this account now. Ashok account data to sales account on January 20th, 28,000 amount of goods we had sold to Ashok, which amount was pending to be received from Ashok. Okay, that now ulta entry for that is in sales account credited by Ashok account. The amount is 28,000. Same January 20th, January 20th. Okay, next transaction is K Murthy account, right? K Murthy, from whom we purchased the goods worth rupees 35,000. Now we paid him cash 34,200 rupees and he gave us a discount of 800 rupees. Right, now we have to go to K Murthy account, where if you observe here, let's go to K Murthy account. Where is K Murthy? Here. If you observe here, when we purchased the goods on January 14th from K Murthy, it was 34,000. On January 25th, cash we paid to him was 34,200. Actually, here it should be 34,200, and discount we got is 800 rupees. There is no need of creating a discount account here. Okay, it is just that we have to show 34,200 plus 800, though total is 35,000. We don't left anything to be paid to K Murthy now. That is what we have to specify here, K Murthy's account. Okay, next in cash account we have to show, no, because we have paid it to him. Now there is nothing left to be paid K Murthy. That is here cash account credited by 34,200 account. That is one thing. Next is cash account debtor to Ashok account. So Ashok is a debtor to us who had to pay us how much amount? 28,000 amount. Now he has paid us 20,000. That we have to show it in our books of accounts. In cash account, we will show cash account debtor to Ashok account on January 28th. Amount is 20,000. In Ashok account, we will credit that amount. Here you can see in Ashok account we are crediting that January 28th cash account is 20,000. What are you understanding here? It is simple. See, Ashok purchased goods from us. Okay, we did a sales to him. So on January 20th he had to pay us 28,000. Now he has paid us 20,000. What is left should be written here, that is 28,000 something. Later that we will show it as a balance carry forwarded, means brought down for the next month, which is still he has not paid. Okay, balance brought down for the next month, February, that we have to show it, because here that is okay, that is he has to pay us 8,000 rupees 8 karke. Whatever there is a difference here, that we will bring it in the debtor side, and that will be rupees 8,000. That will be a balance brought down for the month of February, which he has not yet paid. He will pay it future. Okay, that is what the ledger says us. Okay, next is where did we stop? I think Ashok is done, K Murthy is done. Rent account debtor to cash account. Obviously we have a cash ledger here. We will go to we have to prepare a rent account, or we had a rent account. No, we don't have a rent account. Okay, we have to prepare a rent account here. Rent account debtor to cash account. We have prepared it. One second. Okay, something has gone wrong here in my computer. Don't worry. Rent account debtors to cash account, that we have to debit in a rent account and credit that in a cash account. That is cash account credited by rent account on January 31st. That should be January 31st, rupees 2,000. The last transaction was relating to I think drawings made, right? That was drawings made, the amount drawn from the bank, rupees 2,500 rupees for private use. That is drawings account debtors to bank account, if you remember that, because here I am not able to go back. That is date on the January 31st again. Drawings account debtors to bank account is 2,500, and in the bank account we have to credit that in the right side, bank account credited by drawings account. Whatever we prepare here, I think it is there in the bank account. Let me see if I can account, rent account, no, it is not there in this image. Okay, that should prepared like that. Okay, here it opened. Here we go to bank account credited by drawings account on January 31st 2500 rupees. So this is how we prepare the ledgers for that particular journal entries. Based on that, what we will do, we will add up this debit side amount and credit side amount, okay, for all the accounts whatever is left. Based on that, we will see which amount is there differences in the amount, and what is the amount to be carry forwarded for the future, I mean for the next particular month. Okay, like that only we will prepare. And also based on that, the difference amounts, we prepare the trial balance. Okay, based on these ledgers, whatever there is an amount left, that we prepare it in a trial balance. The trial balance is used to prepare the balance sheet and the profit and loss account. This is how ledgers, journal entries, ledgers, trial balance and other financial statements are being prepared. This is what we call it as the process of accounting, that is your unit 2 of your fundamentals of accounting. This is one example. I will make few more examples based on the different journal entries. Okay, thank you.